I looked at my brokerage account on Saturday morning, and I honestly thought the app was glitching. I refreshed it 3 times.
You saw the silver shark.
I saw silver down 27%.
Yeah.
In 24 hours.
Yeah. Yeah.
I mean, that doesn't happen in real life. That
Yeah.
happens in crypto, maybe penny stocks. It does not happen to a global reserve asset.
It was a historic flush. And I don't think we've seen a repricing that violent in the metals market since, the early 80s.
But it wasn't just silver. Gold fell off a cliff down 10% from those highs near 5,600.
Mm-hmm.
And the exact same time, the U.S. dollar just ripped higher.
Right.
And usually when you see moves that violent, it's because a bank failed or a war started or aliens landed. But this was just a job announcement.
It was. But you could argue it was the most consequential job announcement of the decade. The catalyst for all this chaos is the nomination of Kevin Warsh to succeed Jerome Powell as chairman of the Federal Reserve.
So one guy gets nominated and silver loses a quarter of its value. That is a heck of a reaction function.
Mm-hmm.
And that is exactly what we need to unpack today. We're doing a deep dive into a piece from the Global Review by Dr. Fareed Novin. It's titled Warsh Invading the Bayesian Lab.
It's a fantastic piece of analysis because Dr. Novin doesn't just look at the price action.
Yeah.
He treats this whole situation as a massive experiment. He calls it a high-stakes lab test that President Trump is running on the U.S. economy.
Yeah.
And to understand why the market is freaking out, we have to grapple with this concept of the Bayesian lab.
I saw that in the title. Bayesian always sounds like something from a sci-fi novel or a graduate statistics course. Break that down for us. Why is Dr. Novin using that specific word?
So in statistics, a Bayesian update is just a fancy way of describing how we learn. You have a prior, which is your baseline assumption about the world.
Okay.
And you hold on to that prior until you get new information that is so overwhelming, so undeniable, that you have to violently update your worldview.
Give me a real-world example, because priors feels a little abstract.
Okay. Think of it like checking the weather. Your prior is that it's sunny because the forecast said so. You put on shorts and sunglasses, that's your baseline.
Got it.
But then you walk outside and immediately get soaked by a torrential downpour.
Okay, so I'm standing there in the rain in my shorts.
Right. You experience a violent Bayesian update. You don't argue with the rain. You don't look at the forecast app and say, but it says sun. You instantly drop your old assumption and grab an umbrella. What happened this weekend was the market getting soaked.
Okay, I like that. So what was the old prior? What was the forecast the market was relying on before Friday?
The old prior was that the Fed is a safety net. The market assumed the Fed would stay lower for longer, that it would be politically compliant. Dr. Novin calls this the puppet dove theory, basically that the Fed would always print money to keep asset prices up.
Right, which is why everyone was piling into gold and silver. It was the whole de-dollarization trade. You buy hard assets because you assume the dollar is going to be debased by endless printing.
Exactly. That was the sunny forecast. Then Kevin Warsh walks in.
And brings the rain.
He brings a hurricane. The new prior is the Warsh shock. The market instantly realized, oh, wait, the U.S. is returning to sound money.
Right.
We are looking at a stronger dollar and a Federal Reserve that refuses to bail out speculators.
And if the dollar is going to be strong and stable, you don't need to hoard gold bars in your basement.
Precisely. That is why the trade unwound so fast. Investors were holding metals as alternative reserve assets. But if the U.S. signals a return to orthodox money management, well, the dollar becomes king again. You don't need the alternative.
So the great metal flush was basically the market realizing the dollar isn't dead yet.
Mm-hmm.
But let's talk about the man himself, Kevin Warsh. I know the basics. He was a Fed governor back in the crisis days, worked for George W. Bush. But he's not just an academic, right?
Far from it. And this is crucial context. Dr. Novin highlights that Warsh has been a partner at the Duquesne family office.
That's Stanley Druckenmiller's shop.
It is. And for those listeners who don't, obsessively follow hedge fund legends, Stanley Druckenmiller is the guy who famously broke the Bank of England in the 90s. He is not a buy and hold index fund investor. He bets on structural breaks in the macroeconomy.
He's a shark.
He is the apex predator of macro investing, and Warsh has been sitting next to him for years. So Warsh bridges these two worlds. He has the establishment credentials. He knows where the bathrooms are at the Federal Reserve, but he thinks like a ruthless market operator. He believes the Fed has lost its way.
Okay, so he's a hard money guy coming from a hard-charging hedge fund world. But here is where I get stuck, and I think this is where a lot of people are scratching their heads. We know President Trump wants the rocket ship economy. He wants growth. He wants the market to rip. Usually sound money guys like Warsh are the ones who take away the punch bowl. They raise rates. They slow things down to kill inflation.
Right.
So how do you fit those two things in the same room? I mean, how does Warsh fit into a pro-growth agenda? It feels like a massive contradiction.
This is the billion-dollar question, and this is the core of the lab experiment. To understand Warsh and to understand this nomination, you have to throw out the standard economic playbook. Specifically, you have to burn the chapter on the Taylor rule.
Okay, the Taylor rule. I remember this from Econ 101. It's a formula, right? If GDP goes up and unemployment goes down, the Fed has to raise interest rates to stop inflation. It's automatic.
Exactly. It's the dogma that has ruled central banking for 30 years. It says growth equals inflation. If the economy gets too hot, the Fed has to throw ice water on it.
And Warsh is saying,
No, Warsh and the Trump administration are betting that the Taylor rule is obsolete. Their hypothesis is centered entirely on the supply side, specifically on AI and productivity.
okay, connect the dots for me. How does ChatGPT keep the price of milk down?
Well, think about it this way. Imagine a factory that makes widgets. It costs $100 in labor to run the factory for an hour, and they make 10 widgets. So each widget costs $10 to make.
Simple math, $10 a unit.
Now imagine you introduce AI and robotics. You pay the same $100 for the hour of labor, but now the factory pumps out 20 widgets instead of 10.
So my cost per widget just dropped to $5.
Exactly. You have a massive growth. You doubled your output, but prices actually went down. That is the supply-side optimist view. They believe AI is going to create such a massive boom in efficiency that we can run the economy hot 3, 4, maybe 5% growth without triggering inflation.
So you don't need to hike interest rates to kill growth because the growth isn't inflationary.
Bingo.
Okay.
Dr. Novin draws a direct parallel to Alan Greenspan in the 1990s. Remember the dot-com boom?
I do. The internet was changing everything.
In the mid-90s, the economy started ripping. The traditionalists were screaming at Greenspan to raise rates because the unemployment rate was falling. They said inflation was inevitable.
Right.
But Greenspan looked at the data and said, no, this is real. The internet is making us more productive.
And he let it ride.
He let it ride. And we got the roaring 90s. That is explicitly what Trump wants. The source mentions that Trump wants someone like Greenspan back in the 90s. He wants a market melt-up.
So Warsh is effectively betting that we're on the verge of another productivity miracle.
Yes. Steve Leisman, the economics reporter, noted that Warsh believes the Fed should abandon the dogma that growth creates inflation. That is a radical shift. It means rates could stay lower than the models suggest, fueling even more investment.
That sounds great if it works. It sounds like the Goldilocks scenario.
Yeah.
But Warsh isn't just a cheerleader for growth. There is a darker side to his philosophy, particularly for the banks. The source talks about the badge hot doctrine.
Ah, yes. This is where the Bayesian update gets scary for Wall Street. Walter Bagehot was a 19th century British journalist who basically wrote the Bible on central banking.
And what was his commandment?
His rule for a crisis was simple. The central bank should lend freely, but only against good collateral, and at a penalty rate.
A penalty rate. That sounds very different from the bailouts we're used to.
It's night and day. Think of the recent banking crises, or even 2008. The Fed basically came in and covered everyone's deposits, bought the bad assets, and smoothed everything over. Bagehot is the opposite.
Yeah.
Bagehot is the parent who says, I will bail you out of jail so you don't die, but I am selling your car to pay the bail, and you are grounded for a year.
It saves the life, but it ruins the lifestyle.
Exactly. It reduces moral hazard. Warsh believes the Fed has become too involved in the day-to-day fluctuations of the market. He wants a narrow Fed. He thinks that if banks take stupid risks, they should feel the pain.
And that implies shrinking the balance sheet, right? Quantitative tightening.
Aggressive quantitative tightening. Warsh hates what he calls balance sheet bloat. He actually supported printing money in 2008 when the world was ending, but he broke with Ben Bernanke later on. He thought doing QE2, QE3, just pumping money when the emergency was over, was a disaster.
So he wants to sell off the assets the Fed is holding.
Significantly. Now, think about the plumbing of the financial system. For 15 years, the Fed has been the biggest buyer in the room for treasuries. If the Fed steps away,
Then who buys the debt? And, more importantly, if something breaks, is the Fed put gone?
that is the fear. The Fed put, the idea that the Fed will step in to save the stock market if it drops too much is effectively dead under this doctrine.
Wow.
Market participants are genuinely worried that Warsh will be, as the source puts it, less likely to come to the market's rescue.
That sounds like a recipe for extreme volatility. I mean, we saw what happened in the repo crisis in 2019 when liquidity just dried up.
Exactly. If Warsh is ruthlessly shrinking the balance sheet to teach banks a lesson, we could see the gears of the financial system seize up. It's a trade-off. You get sound money in the long run, but the transition period, that could be a violent roller coaster.
So we're switching engines on the airplane while in mid-flight. We're going from the easy money engine to the productivity and sound money engine.
And just hoping we don't stall out.
But there's a weird timing issue here. Today it's February 2nd. Warsh doesn't actually take the keys to the office until May.
The shadow chair period.
Yeah, it's awkward. Jerome Powell is still technically the boss. He's sitting in the chair.
Yeah.
But the market is listening to Warsh.
It creates a two-headed Fed. It's incredibly destabilizing. Warsh's rhetoric is driving capital flows right now. That's why the dollar is up and gold is down. But Powell is the one who has to sign the orders for the next few months.
Right.
Powell is effectively a lame duck, but he's a lame duck with a printing press.
And this isn't just messing with Powell. This is wrecking plans globally. I was reading about the impact on the G7.
Oh, it's a nightmare for them. Look at Europe. The Eurozone economy is sluggish, bordering on recession. Normally, the European Central Bank would cut rates to stimulate growth.
Right. Econ 101 again.
Yeah.
Economy bad, cut rates.
But they can't, because the Warsh trade has made the dollar so strong. If Europe cuts rates while the dollar is surging, the euro will collapse.
And if the euro collapses, their imports, energy, food get incredibly expensive.
Which causes inflation. So the ECB is trapped. They're being held hostage by U.S. policy. The U.S. economy is expanding. Manufacturing PMI just jumped to 52.6 so we can handle higher rates or a stronger dollar. Europe cannot. But they have to follow us anyway.
That is wild. The U.S. starts sprinting, and Europe trips over its shoelaces trying to keep up.
And there's one more layer of friction Warsh faces. He hasn't even won over his own building yet.
Right, the internal politics. The Fed chair isn't a dictator.
Becky Quick made a great point in the notes. The chairman cannot unilaterally determine how the FOMC votes. The Federal Open Market Committee includes all these regional bank presidents, people like Jeff Schmid or Alberto Mussolem.
And they have their own opinions.
They do. And Warsh has been, let's say, less than polite about the Fed staff in the past. He's criticized the permanent bureaucracy of PhD economists.
Ooh, that's got to make for some awkward elevator rides when he arrives in May.
Hey, guys.
Hey guys, I know I said your models were trash, but who's signing the birthday card?
It suggests there's going to be serious internal conflict. He wants to reorganize the staff and change the analytical frameworks. But the institution has a lot of inertia. He has to convince 12 other people to go along with this radical Bayesian update.
So let's try to pull this all together. This Warsh lab experiment, it's a massive bet.
It is the biggest economic bet of our lifetimes. The formula is deregulation plus AI productivity replaces low interest rates and QE.
That's the bumper sticker. But what if they're wrong? What are the risks here?
The risks are substantial. First, the timing mismatch. What if the AI productivity boom is real, but it takes 5 years to show up?
But the tariffs raise prices tomorrow.
Exactly. Tariffs are taxes. They raise prices immediately. If you have tariffs pushing inflation up and you don't have the productivity gains yet to push costs down, you get stagflation. High prices, but the sound money policies choke off growth.
And then there's the liquidity risk, the no safety net problem.
If the private market gets scared, if we have a shock, and Warsh refuses to answer the phone because he's following the badge hot doctrine, we could be looking at a massive correction. A 2027 recession that is deep and painful because the Fed refuses to cut rates to stop it.
It really is a high-wire act, no net, just trusting the balance pole of productivity.
And that brings us back to the most unsettling part of Dr. Novin's analysis. He ends with the concept of costly information.
Costly information. Unpack that for the listener.
It means the market is a learning machine, but the tuition is expensive. To learn that the Fed put is dead, someone had to lose 27% on their silver position in one day.
We have to break things to find out where the walls are.
Exactly. We are entering a period where the market has to map out a completely new reality. No safety net, high-tech growth, strong dollar. Every time the market misunderstands Warsh or misjudges his resolve, it's going to cost someone billions of dollars to correct that mistake.
That is a slightly terrifying thought. We're all in the lab, but we don't know which chemicals explode yet.
And the experiment is just starting. The Great Metal Flush was just the first data point.
Well, on that note, check your portfolios, everyone.
Yeah,
And maybe double-check your assumptions while you're at it. We will be watching the Warsh lab very closely in the coming months.
indeed.
Thank you for listening to this deep dive. If you found this helpful, or if it just explained why your net worth looks different today, share it with a friend. We'll catch you on the next one.